Hi everyone, and welcome back to this this lecture on other Solvency II information. We have one piece left to go, and it's relatively short. It's all about supervisory intervention, which just means when the regulator gets involved in the running of a company. So let's give ourselves this this title. Supervisory intervention. Okay, so after SCR calculation, the company must also calculate an MCR. So this, the MCR stands for minimum capital requirement. The calculation of MCR uses a linear formula based on various components. So again, this is just another formula from the regulations. But the result of the formula is constrained, so 0.25 times the SCR is less than or equal to the MCR, which is less than or equal to 0.45 times the SCR. So this MCR number is bounded below by this number and above by this number. So it can only exist in this range. So that's useful. The regulations require you to know what your SCR is and also what your MCR is. Why is this relevant? Because it affects what the regulator does if your asset values fall. So if, let's put this in blue, market value of assets is less than or equal to, I'll write this as BEL plus the risk margin plus SCR. So this BEL and RM could be replaced by market value of liabilities. But yes, if the MV of A is less than or equal to this result on the right-hand side, then regulator talks to you about how this will be fixed. But I would say even if you're getting close to this level, if your market value of assets are dropping so they're getting close to this BEL plus risk margin plus SCR, then the regulator is probably talking to you already. And the regulator is probably interested in the fine detail of how the company is working already. The impact of getting close to the MCR is different. So suppose the market value of assets the market value of assets has dropped below this, but perhaps even further. So let's say if market value of assets is less than or equal to BEL plus risk margin plus MCR in this case, MCR, then regulator fully intervenes in the running of the company. The regulator can then take various actions. So, if your assets fall so that you're getting close to BEL plus RM plus SCR, that's not great. And certainly if it falls just below, the regulator is going to start speaking to you. But if the value of the assets drops even further, so it ends up dropping below BEL plus risk margin plus minimum capital requirement or minimum capital required, then the regulator fully intervenes. Okay, so they're trying to protect policyholders here. And they could do a number of things. They might close the company to new business. They might take the company into public ownership. They might, so that means that the state owns the company. They might do something where they look for another insurance company to buy the company in order to put more capital in order to fix this problem. But basically, it means that there's not enough money floating around in the company. So both of these figures are particularly important, the SCR and the MCR. And these two things, if your assets fall low enough, can trigger different kind of levels at which the regulator is kind of interacting with you or dealing with you. So both of these are important. Okay, good. So that brings us to the end of this section. So that's supervisory intervention covered. So we've done the three pillars. Those are the kind of three main components or areas of Solvency II regulation. We've done the two kind of different ways in which you can reduce the amount of capital that is required. One of them is the matching adjustment, used a lot in the UK for companies that are using corporate bonds and other assets to back annuity type liabilities. And the other is the volatility adjustment, which is similar in that it is effectively also in addition to risk-free interest rates. But it's used to prevent or discourage companies from selling certain assets when those assets fall in value, and so trying to make sure that insurance company behavior doesn't create or exacerbate a market crash. And on the supervisory intervention stuff, you just need to know that there's not just an SCR calculated, but also an MCR. And depending on how low solvency falls, that will impact the extent to which the regulator is just having a chat with you, or whether the regulator is really strongly intervening in the running of the company in order to protect policyholders. Okay, let's stop there.